You can own an IUL on your spouse, your children, your business partner. That's called a surrogate-insured. Why do you want to own one on them? Maybe you can't qualify health-wise yourself, okay? But you can own one on somebody else, and you, as the owner, gets all the tax-free accumulation and tax-free access to the money, okay? Now, a lot of times on my YouTube channel, people say, well, golly, that sounds good, but I can't qualify for an IUL. But they're shocked when I show them that actually, even if you had a heart attack or open heart surgery or you're diabetic, don't rule yourself out. But if they can't qualify, I go, no problem. Just own one on a surrogate. Buy one, and the insured can be your spouse, your kids, a business partner, but you're the owner. You get all the tax-free income and tax-free growth on that policy, okay? So get ready, watch my full episode to understand how you do this and the 5 parties to an insurance contract. So I'm Doug Andrew. I've been a financial strategist and a financial retirement planning specialist now for more than 5 decades, helping thousands of Americans optimize their assets, minimize taxes, and empower their authentic wealth. And so if you watch my YouTube channel videos very often, you know that my favorite financial vehicle, without question, is a properly structured, max-funded, indexed universal life. Life what? Life insurance policy. And so a lot of times people watch the videos and they go, what about me? And I'll say, well, what about you? And they'll say, well, I can't qualify. Oh, don't rule yourself out. And then I begin to say, why do you think you can't qualify? Well, because 7 years ago, after I had open heart surgery, I was turned down. So if you've had good health and it's been 7 years, you're now insurable for most, unless somehow your heart's doing worse, okay? You had some stents put in or whatever. Or I'm diabetic. So we can shop insurance companies, and it's amazing how many companies will accept people that thought they were uninsurable, okay? Or, I'll get a load of this one. We had a friend of our family who came to us at age 78. And he had 3 blocked arteries that he cleared up with angioplasties, okay? Adult onset diabetes, but he was trying to control that with diet and exercise as best as he could. And he had a prostate cancer episode, but his PSA levels came down pretty good after that. But he had 6 sisters, all died, predeceased him. He had 3 brothers. They were all dead, okay? But he had better habits than his siblings. He had never used tobacco or alcohol, and most of them did, okay? And so at age 78, we shopped several insurance companies, and we found 2 companies that would insure him and rate him Table D. Table D. What's that? That means the cost of insurance for him is double that of a normal 78-year-old, which you would think a 78-year-old, the insurance is expensive. No, not with IUL when you structure it right. So his LE, his life expectancy at age 78 was that of an 83-year-old, okay? All we have to do is take the least amount of insurance to All we have to do is take the least amount of insurance to accommodate the amount of money he wanted to put into an IUL for living benefits. He wasn't doing it for death benefit. He was doing it for tax-free income. So he wanted to put in $500,000 into an IUL, and he did. He wanted to earn 11% and net 10%, which we do for our clients. He did. He wanted to be able to start pulling out $50,000 a year of tax-free income, a 10% payout tax-free without depleting the principal, okay? We do this all the time. And so the cost of insurance for him was the same as a 20-year-old athletic marathon running female. If a 20-year-old female came to us to put in $500,000, the amount of insurance required to accommodate $500,000 for her at age 20 might be $4 or $5 million. For him at age 78, if he was in good health, was like $850,000. See, the amount of insurance is less every year older you are. So the cost of insurance for him is the same as a 20-year-old. Okay. He wants to earn 11 and net 10. And so he gets away with less insurance. You can't believe how many agents don't understand how to do that. So the cost of insurance was the same, but then we found out he was rated table D. Well, instead of earning 11 and only netting 8, we were able to earn 11 and net 10 by getting away with even less insurance. Because if you're rated, you can squeeze down the death benefit to $650,000. And people say, well, who pays $500,000 for a $650,000 life insurance policy? He did. Why? Because, if he happened to die, $500,000 blossoms to $650 tax-free. That's not why he did it. He did it so that $500,000 in the IUL would generate $50,000 a year of tax-free income, which it did for the rest of his life. Okay? So now, if he would have been totally uninsurable after we shopped companies and they said, nope, we don't want to touch that guy with a 10-foot pole. Okay? We think he's got 1 foot in the grave or whatever. Then I would have put the insurance on his spouse, who was healthy, or his 3 adult children. That's called a surrogate-insured. And he would have still been able to put in $500,000, earn 11 and net 10, because he's the owner of the IUL, even though the insured is his wife or his 3 adult children. Hello? Okay? It's the owner who gets all the tax-free accumulation and tax-free access to the money. Okay? Now, folks, let me show you how this works. You need to understand the basics of the 5 parties to an insurance contract, okay? So there's 5 parties to an insurance contract. It's a contract with the insurance company, okay? We call this an insurance policy, but it's a contract. The insurance company is on the hook. They're taking risks in case you do die. But they're also going to invest money so you can use it for living benefits. So the insurance company is the one incurring the risk that if you put in $500,000, they're going to pay out, more than that if you die the next day. So that's the insurer. That's the first party. You have to have an insurance company. Okay. Now there's the insured. That's the person that the insurance is on. Okay. Now usually the insured and the owner are the same person, but they don't have to be. So the insured is the one that has the life insurance on them. Okay. Now we have a beneficiary. That is who is going to receive the life insurance death benefit, which is tax-free when the insured dies. Okay. Now, in order to get qualified, there must be an insurable interest between this person and this person. Okay. This, you have to prove to the insurance company during underwriting, when you take out the policy, that this person or entity, this beneficiary, must suffer an economic loss. You have to prove that this beneficiary will suffer economically a loss by virtue of that insured's death. That's called an insurable interest, okay? You can't just go out and buy $1 gazillion of life insurance. They will only insure you for a certain factor of your income or a certain percent of your, a certain factor of your net worth, okay? You can't just go out and buy as much life insurance as you want, because there's nuts out there who are part of cults, and they have bought $5 million policies, and then they turn around and strap bombs around themselves and blow themselves up to leave behind $5 million to their, cult. Okay, and so no, you have to have an insurable interest at the time of underwriting. Okay, now there's also the premium payor. Now that's usually the insured and it's usually the owner, but it didn't have to be. The premium payor is the one that's paying the premiums into the policy. Okay. Now, there's one other party, and that's the owner, okay? Now, the owner is usually the insured and the premium payor, but doesn't have to be. I've had policies where the insured might be grandma and grandpa, or the insured might be their adult children. And they put insurance on their adult children, and the grandparents are paying the premiums, and the beneficiary is the family bank or the trust, okay? And the owner is the family trust, okay? So these can all be different parties, but, I have owned life insurance not only on my own life, but on my spouse. I've owned life insurance on my father. I couldn't on my mother. She was uninsurable earlier in life because of heart issues. I've owned life insurance on my mother-in-law, my father-in-law. Why? Do the math, okay? Let me reverse it, okay? We all have what is called insurance capacity. And so what I just explained a moment ago, an insurance company is not going to insure you for $1 bazillion. There's only a certain amount of capacity. When you're younger, when my wife and I were, age 30, and at that point we had 5 of our 6 children, then at age 30, most insurance companies will insure me for up to maybe 30 times my income. So if I was making $100,000 a year, 30 times $100,000 a year is $3 million. Without question, they would insure me for $3 million, so that if I died, my beneficiaries, my wife and my kids, would continue to maintain the same lifestyle that I would have provided had I stayed around, had I lived longer, okay? So that's 3 times my income. Now, as I get older, and if I die at age 60, the amount of years remaining before my life expectancy is less, and the kids are gone. So now they're not dependent on me anymore. And my spouse may not need as much money, but I'm probably earning more money. So the insurance company might only insure me for 12 times my income, not 30 times my income. But if my income is $1 million a year, they'll insure me for 12 million, okay? So besides a factor of your income, they can insure you for a factor of your net worth. So if you have a net worth of 5 million, they'll insure you for 5 million, pretty much no brainer. I've actually helped many clients get insured for double and triple their net worth, but let's just keep it simple. If you have a net worth of 5 or 10 million, you qualify for that much life insurance. Now, to be honest with you, there's a lot of people that that are older, and the dirt behind their house, the IRS says, because of all the development that's gone on ever since that's been there, they're in the family for 3 generations, but because of development or whatever, the IRS says that's worth $3 million. And these people, at age 60, they're like, well, we're land rich, cash poor, because we don't even have $30,000 in the bank. Okay, and maybe they want to leave behind $100,000 or $1 million when they die to their favorite charity or to their church or to the senior citizen center. They want to put a plaque up on the wall, but they say, well, I don't have any money. And I go, so you have insurance capacity of $3 million. Yeah, but we can't afford $3 million of life insurance. I go, who said you had to afford it? So we actually have lenders who will loan the premiums on a $3 million policy. Okay. It could be $50,000 or $100,000 a year, and these lenders will loan $100,000 a year. But why would they do that? Because when they die, they get the aggregate amount of that loan back plus interest. But by the time they pass away, in 7, 10, 15 years, if the loan has grown to 1.5 million, but the death benefit is 3 million, the lender gets back their money with a really nice interest rate, and the remaining 1.5 million goes to the church, the charity, the family bank, whatever, okay? And they didn't have to come up with any money. They actually donated their life to be insured because they had insurance capacity they weren't using, okay? Did you get an epiphany just then, okay? Now, I had a discussion with my adult children years ago, and I had a bunch of insurance capacity that I wasn't using. And I said, kids, I have some insurance capacity. I'm not going to buy life insurance on me. I'm not going to pay for it, but I will allow you, as my children, to buy life insurance on me. And if you bought $1 million policy on me, you'll be an automatic millionaire when I die. Try to look down and look sad at my funeral, is what I say. Now, why would I recommend they do that? Do the math. When I said that to them, if they bought $1 million policy on me, if each of my 6 kids had done that, okay, $1 million policy they could have gotten for as little as $500, $600, $700 a month. Now, if they put $500, $600, even $1,000 a month into an IRA or 401k, I would have shot them because they know better, okay? But if they did that in an IRA or 401k, that IRA or 401k would have to earn over 12% rate of return for 30 years before it would grow to an amount that would net them $1 million after tax on that IRA 401k. Here they put 500, 600, 700, 1,000 a month into an IUL on me. And if I die anytime in the next 30 years, they'll be a millionaire that fast. Within 3 weeks, they'll get $1 million tax free. Okay. So do the math. Look at what it does. Okay. Quit looking at what it is. So let's get back to this concept. The owner of the insurance contract gets all the tax-free accumulation and tax-free income. My kids could have maximum funded it instead of waiting around till I die, okay, which they could have done, and it would be all their money because they own it on me. I own it on them. I owned it on my my mother-in-law and father-in-law, okay? And so, see, it's the owner of the insurance contract that gets all the tax-free accumulation and what have you. So if you're unhealthy, or you have insurance capacity, or somebody in your family has insurance capacity they're not using, you say, can I use it? And you become the owner on your spouse. They're the insured, okay? You're the owner. You're the beneficiary. You're the premium payer, okay? But you're using a surrogate life. Someone else says. Now, in order to do that, remember, you have to get it approved with other underwriting because you have to prove reason and justification that the insured's death would create an economic loss for the beneficiary. If it's on your spouse, the beneficiaries are maybe you or the children that you'll suffer economically. That's pretty easy to do that. If it's your children, you have to prove that you would suffer economically or whatever. But you can actually change the owner after the policy is taken out. You can change the beneficiary as soon as the policy is taken out because you're the owner. You call all the shots. Did you get some epiphanies in this episode? Okay. So what I'm talking about here, if you property structure max funded IUL and without diversifying and rebalancing, you might earn an average of 7.2%, which is pretty much a no-brainer if you understand how to do it correctly. You can't believe how many agents who sell IUL, the cash value doesn't equal the premiums they paid into it in 20 years. Your cash value should grow to equal and exceed the death benefit within 10 years, okay? Now, $500,000, if it's structured correctly, pretty much you could earn a net internal rate of return of 7.2%, which is the worst rate of return we've ever achieved by not having annual reviews. That means $500,000 will double to $1 million in 10 years, to $2 million in 20 years, and $4 million. You wouldn't believe how many IUL agents don't even know how to do that. If they generated a 7.2% rate of return, the client would be lucky to net 1 or 2, okay? But what we do is we teach you how to rebalance by having annual reviews, diversifying, and then that $500,000 will earn 2.4% higher rate, 9.6. What's the difference between 9.6 and 7.2? You say, not much. Oh, it's double. Because now your $500,000 doubles every 7.5 years. You divide that into the rule of 72. In 7.5 years, it goes to $1 million, then to $2 million in 15 years. In year 22.5, it's worth what this one is in 30 years. 7.5 years faster. And in the year 30, it's worth double what this one's worth. What I'm saying is you need to make sure you talk to an IUL specialist who knows to do at least this, but better this, which is double. And you don't have to be healthy to be able to own one of these. The owner is the one that gets this. You can own this on your spouse or your kids. Don't rule yourself out. Frankly, I'm getting a little bit tired of answering that question on my YouTube channel. Well, this sounds wonderful, but I'm not healthy. Tell me something else I can do. I'm telling you right now, you can still use IUL. You own it on a surrogate-insured, but make sure you know how to do it by talking to a professional. So I'd recommend you study my book, The Laser Fund. It's been flying off of our warehouse shelves. It's a 300-page book. It's a bestseller. Now, it's actually 2 books in one. This white-covered side is about 200 pages. Comprising 14 chapters with all the charts and graphs and explanations if you're a left brain learner, okay? But if you're a right brain learner, you learn more by stories and examples of how it actually works in real life, you simply flip it over to this book. And this is about 100 pages, 12 chapters with 62 actual client stories of how property structure max funded IUL is the dream solution for all kinds of goals, for retirement, for emergency funds, for business working capital, for real estate management, for pension maximization if you're a school teacher, police officer, or firefighter. It knocks the socks off of a 529 college savings plan. And so you can read all those stories, okay? Now, if you want to use your whole brain, you can read both books, okay? Now, you can go to Amazon and pick it up for anywhere from $20 to $60, and plus shipping and handling. If you do that, thank you. But I'll give you a copy free. See, you simply go to laserfund.com or click on the link below. Now, don't start complaining. Well, he said it was free. I had to pay shipping and handling. I require some skin in the game. Come on. You contribute a nominal amount towards the shipping and handling, and I'll cover the rest of that, and I'll pay for the book. I'll fire out a hard copy to you via priority mail. And while you're in there claiming your free copy, if you like to listen and learn or watch and learn, there's those formats available for your investment. They're not just free. Okay, come on. How much did you invest in your college education to learn how to make money, but you never learned what to do with money? Hello? For less than $10, I'll teach you what to do with your money so you will not outlive your money. Now, while you're in there also, if you want to register for our free educational webinar that we teach on a weekly basis, you can do that with no cost or obligation, but you can also schedule an appointment with a property-trained IUL specialist that I oversee so that they can create illustrations that will show you how to set it up correctly so that worst case, you're at least netting 7.2%, but better 9.6%, which is going to be double the result over a 30-year period. I'd recommend you talk to an IUL specialist that will do this versus that or worse, because I go sick when I see IUL agents out there that don't even perform at this level because they don't know what they don't know. So if you study the book here, you'll know more than 99.9% of IUL agents out there. If you're an IUL agent, you better learn, or else your clients who read this book will know more than you do. And so this is not about me. This is about you and your brighter future, whether you're a person who wants to optimize your assets or whether you're an agent, but you don't have to be healthy to own one of these. The owner gets all the tax-free accumulation and tax-free income so that every $1 million in an IUL can generate $100,000 a year of tax-free income. Don't miss out.